Well, the previous week we discussed how you manage a portfolio. Hi, thank you for coming online. The previous week we discussed how you manage a portfolio. So today will be through a recorded session. If you have any questions, you can ask when we meet on a live session. Right. So under portfolio management, we discussed modern portfolio theory. And under that, we discussed the benefits of diversification. We discussed systematic risk, unsystematic risk. So the portion of risk which cannot be reduced through diversification is called systematic risk. What you can reduce through diversification is called unsystematic risk. Right. So two types of risk, and for there to be, we discussed correlation, and that for there to be diversification benefits, you need to have assets which are not perfect positive correlated. Right. So assets with perfect positive correlation will not give a diversification benefit. Right. So those were the things we discussed last week. Then we discussed how to calculate the variance of a two-asset portfolio, how to calculate the return based on probabilities and weights. Right. So we will move on from there. Right. So we'll start off with the risk-return trade-off once again, where we stopped last week. It says low levels of uncertainty or low risk are associated with low potential returns. Right. So if you put your money in treasury bills, the return you get is minimal, very low return. High levels of risk uncertainty are associated with high potential return. So if you take a high risk, you invest in shares, the return you expect should be higher. But having said that, the risk is also high. So you might end up losing at the end of the day, because the risk is high. There is not only a risk of gaining, there is not only a probability of gain, there is also a probability of loss. Right? So both of those should be looked at. The risk-return trade-off is the balance between the desire for the lowest possible risk and the highest possible return. Right? So now, low risk is associated with low return, high risk with high return. So where do you strike a balance? Somewhere in between. What is your risk appetite? And based on that, what is the return you could expect? A higher standard deviation means a higher risk and higher possible return. And so standard deviation measures risk. So higher standard deviation is to do with higher risk. An investor still faces substantially greater risk and volatility to get an overall return that is higher than a practical government security. We call this additional risk the risk premium. Right? Remember last week we discussed if a government treasury bill, 1 year treasury bill offers 5% and the finance company offers 8% for 1 year, 3% represents the risk premium. Determining what risk level is most appropriate isn't an easy question to answer. So how much of risk can you take? It depends on you. Then how much of risk you can take for the fund that you manage? It again depends on the risk tolerance of investors. Risk tolerance differs from person to person depending on goal, income, and personal situation, among other factors. For example, if you take a young guy who has just started, just left school, started working, maybe if he's rich, well off, compare him to a mid-career professional, right? Or a person who is about to retire doing the same job. Now, their risk profiles will be different based on the age. Right? A young school leaver will have maybe a higher risk tolerance, a higher risk appetite. Not a tolerance, but a high risk appetite compared to a person who has retired. Because he has, the youngster will have a longer time period. The person retired will have so many things to do after retirement, maybe plan for children's education, the marriage and all that, wealth transfers. Right? So their risk appetites will differ based on age, for example. Also, can differ based on life cycle of a person. Right? So mid-career people will have lots of other things to do, like they'll have to purchase properties, right? Build a house, maybe buy vehicles. So the things that you require during your lifetime will determine your risk appetite and the tolerance. Maybe your goals. What are your ambitions? Right? Are you planning to do higher studies? Are you planning to do your banking exams, for example? If so, you will need cash to invest in your exams, your studies. Personal situations, among other factors. What is your health condition like? Right. So if you are healthy, Maybe you might buy a basic insurance product and continue, right? So it depends on personal situations, among many other factors. Right, so move on to capital asset pricing model. The underlying assumptions of capital asset pricing model. Now, this is a model which you need to remember. Right? The principles of this model has to be remembered, can get tested at the exam. Having said that, everything that we have covered so far can be tested at the exam, right? So you need to be prepared. Assumption is investors need only know the expected returns, the variances, and the covariances of return to determine which portfolios are optimal for them. Right? So if you are an investor, you only need to know these factors. What is the return, the variances, and the covariances. Right? Then what it assumes is you don't need to know anything else. Investors have identical views about risk assets on their returns, variances, and correlations. Right? So if all investors in the market will have identical views about a particular asset. Investors can buy and sell assets in any quantity without affecting the price, and all assets are marketable. Now, these are signs of an efficient market, right? A perfect market, in fact. Perfect markets, right? So perfect markets will have these features. These are all features of perfect markets. Investors can borrow and lend at risk-free rate without a limit. And they can short sell any asset in any quantity. Investors pay no taxes on returns and pay no transaction cost on trades. These are signs of perfect markets. Perfect markets, there are no transaction costs. Perfect markets. Remember last week we discussed efficient markets. Now perfect markets are perfect markets. This will never prevail in practice. Right? You can become efficient, but you can't be perfect. No transaction cost. Zero transaction cost. No tax. Shorts, buy or sell in unlimited quantities. Everyone has the same information. There is no information and advantages. Can borrow unlimited amounts at the risk-free rate. Okay, so these are signs of perfect markets. Perfect markets. No transaction cost. No tax. Buy or sell unlimited quantities. Everyone has the same information. And you can borrow and lend unlimited quantities at risk-free rate. So these are perfect markets, perfectly efficient markets. The following equation describes the expected returns on all assets and portfolios, whether efficient or not. Right. So this equation you need to memorize. Says your expected return is equal to risk-free rate plus beta times the risk premium, which is market return minus the risk-free rate. Right. Market return minus risk-free rate is called the risk premium. Now, beta is the sensitivity. Right? Beta measures the sensitivity to the market. Right? So, if the market changes by 1%, if the market changes by 1%, and if this particular share, let's say for example, you are using John Keells, right? So if market changes by 1%, if John Keells changes by 5%, then beta is 5. But if John Keells changes by 0.5, then beta is 0.5, right? Which means if beta is more than 1, if beta is more than 1, this is more. If beta is more than 1, the share is more sensitive than market. Beta is more than 1, the share is more sensitive than market. And if beta is equal to 1, it's equally sensitive as the market. And if beta is less than 1, less sensitive than the market. Right, so this is how it works. Now, what happens if beta is 0? Remember, beta will always be positive. Beta has to be a positive number. You can't get negative betas. Okay. That is by definition. So beta is 0. Your expected return is equal to risk-free rate plus this entire thing becomes 0. Right? Beta is 0, you end up with the risk-free rate. That means you have invested in treasury bills. You have no other investment. Then if beta is 1, your expected return is equal to risk-free rate plus beta is 1 times the market return minus risk-free rate. Right. Which is your risk-free rate plus the market return minus risk-free rate. So this cancels off. You will end up with the market return. Beta is 1, you get the market return, which is pretty obvious. Beta is 1 means you're equally sensitive as market. So you end up with the market return. Okay, so that's how it works. Capital asset pricing model says that the equation is referred to as the capital asset pricing model, and this graph is called the securities market line. Right, so if you put various figures in this, the graph that you get, that is expected return against the various beta factors, is called the securities market line. Beta is a measure of the asset sensitivity to market movements. CAPM says that the expected return has two components, the risk-free rate and the extra return or the risk premium. The term market return minus the risk-free rate is the expected excess return on the market or the risk premium. Beta less than 1 indicates then less than average market risk and earns a smaller expected return. So if you have beta less than 1, means you're taking less than average market risk compared to the market, and your return will be less than market return. Right? Sorry, it earns less XX premium compared to the market. Beta equals 1, you earn market return. Beta more than 1, you earn higher premiums. Right? This will be more than 1, then you earn a higher premium. Beta more than 1 indicates more than average market risk and earns a larger expected excess return. Asset allocations, right? So asset allocations, there are 3 types, can be strategic, dynamic, or tactical asset allocation. So strategic asset allocation means that's where you set weights for each asset class depending on the long-term expectation about the market. Right? So you look at the long term. What is your strategy? Now this is usually given by the board. Right? The board decides on the strategy. So your strategy will be to invest in maybe equities because you expect markets to go up, or you invest in companies. Maybe now, for example, the government has the intention of developing local industries, so you might invest in local industries. Right? So that direction will be given usually by the board because it's long term. They strategize for the long term. It's a set of weights for each asset class depending on the long term expectation about the market. You can use a top-down approach or bottom-up approach. So top-down means you analyze the various sectors and pick the best. Bottom-up is you analyze what sort of return you expect and then go up, drill upwards. Like from the expected return, you arrive at which industry you should focus on. Tactical asset allocation, it's slightly shorter term than strategic asset allocation. It depends on short-term views. Right? Short-term views. Dynamic asset allocation involves frequent readjustments to investments in line with performance over time and market trends. Right? So dynamic asset allocation, you are more active. You adjust your portfolio more often in line with market expectations, right? So if you feel the banking industry is going up this next week, you will start buying banking shares. Then if you want to switch to maybe conglomerates, you start selling your banking shares and get into conglomerates. From there, if you want to shift to the government industry, you start selling your conglomerates and shift to governments. Then maybe hotels the week after. Likewise, you keep changing your asset allocation based on expectations in the market. Consider the risky strategy because you don't have a long-term goal, you don't have a long-term view, you can keep changing, and your transaction cost will also be very high because you trade very frequently. It does not involve keeping a fixed investment ratio. Evaluation of current market trends and prediction of future trends on investments are very important with dynamic asset allocation. And so it's very important that you evaluate current trends and forecast future trends, what is going to happen in the future. Right? So that is portfolio theory. I hope it was clear. And if you all have any questions, you can always ask when we meet again to a live session. Right, so let's move on to the next area. Now, derivatives, many of you would not have come across in your life, but that statement is not quite true. And because we come across derivatives very often. When we borrow, when we lend, with or without us knowing, we are getting into a derivative transaction, right? So but we don't understand that we are getting into a derivative, right? It's based on the concept of default, because default, now, for example, is an option that you get. If you take a loan and you default, you have an option of defaulting. There may be other consequences of defaulting. Consequences of defaulting might be there. Maybe your credit will go bad. You might not be able to borrow again. There can be other repercussions. There can be legal proceedings and all that coming in. But nevertheless, you have the option of default. Like, you can default if you want. Not that it's good. I don't endorse, but certainly there. There's been many cases of companies defaulting, individuals defaulting. Now, recently it was published that the banking sector NPL ratio has gone from, if I remember right, it's 4.9% to 5.1%, which is not good. NPL levels are increasing, right? And for non-bank financial institutions, it's much more than that. It's about 7% odd, which is very high ratio, right? And the challenge is we need to see where the NPL ratio is heading after the moratoriums end, right? So, but definitely default option is there. Now, you will default if if a customer defaults, right? He will default because the benefit he gets from default will be more than the repercussions, isn't it? That will always be the case. Otherwise, one way or the other, you will pay. Yeah. Because even if he doesn't want to default, he has no choice but to default, because eventually that might be the case, right? You might understand when we go down further. So derivatives. Derivatives is an instrument. Its value depends on or is derived from the value of other assets, such as stocks, currencies, interest rates, and commodities. It's an instrument, and the value depends on or is derived from the value of other asset, right? So it's the value of a certain asset depends on the value of another asset. Now, for example, if you take body mass index, right? So it's the weight divided by the height squared, something like that. Now, it gives an indication of whether a person is healthy or not. And the body mass index is based on, it's derived from your height and weight as a ratio of the height and weight. But it indicates health. So likewise, derivatives can be structured from various assets like stocks, currencies, interest rates, and commodities. Right. So there are four main types of derivatives: forwards, futures, options, and swaps. Yeah. Now, this is an interesting statistics. Right. The size of derivative markets, 693 trillion. So it's huge, massive. And why do you use derivatives? Why use derivatives? Risk mitigation. You cannot eliminate risk, but you can manage it, right? So if you want to manage your risk, you might think of using derivatives. It can reduce cost, enhance return, and allow investors to manage risk with greater certainty. So that's the important point. Derivatives can reduce cost, right? We'll see how it is done. Enhance returns, and can allow investors to manage risk with greater certainty. So you might be able to manage your risk with more clarity, certainty. Derivatives can be used for speculation, very risky due to high leverage, and more versatile than underlying instrument. Okay. Now, interesting term that we came across, leverage. What is leverage? Leverage means to borrow and invest. You are not investing your own money. You will borrow and then invest. Right. Now, for example, if you had $100 and you invest it at 10%. After, let's say, after 10% for 1 year, so after 1 year, you will get a return of 10. Now, this is your capital, your return percentage, and the return that you generate. So $100 invested at 10% gives you a return of 10 after 1 year. Now, if you are not happy with this return, what you can do is you can borrow. Maybe you borrow 1,000, right, at 8%. You do this. You borrow $1,000 at 8%. What you do is you get the money. You receive $1,000 which you have borrowed at 8%. So there is a cash inflow. The cash inflow you deploy. You put it in the same investment. Maybe it's FD. So you invest. Now you invest 1,000 at the same return, 10%, and you get a return of 100. Right. So when this FD matures, you get your cash back. Using the cash, you pay the loan. Right. Loan is settled. But you also have to pay interest at 8%. On $1,000, which is 80. Right. So this original investment is also still there. Original investment is there. You invested, borrowed 1,000 and invested again in the same investment, and you pay your interest cost. Right. So after 1 year, you will end up with 30, a net of 30. Now your return is 30 and you have settled your loans, but your actual investment amount was originally 100. No? So you get a return of 30 on an investment of 100, meaning your return on investment is now 30%. Whereas if you had done nothing, you would have ended up with a return of 10%. Now you are getting 30%. Fantastic. Fantastic. Your borrowing has generated a positive result for you. You are enhancing your return from 10% to 30%. Okay. Right? So looks a fantastic investment. Now what is the risk? What if by any chance your borrowing cost all of a sudden went up? It shoots up, let's say, 12%. You end up borrowing now at 12%. So instead of paying 8, you have to now pay 12. Right? So you have your original investment, which gives you 10. Your borrowing gives you 100, but you have to pay 12% interest. So your net will be negative 10. And negative. So what about your return on investment in this case? Will be 10% negative. Right. You end up with a negative return of 10%. You end up with a negative return of 10%. Right? This is a terrible return, no? Because if you had not done this, if you had not borrowed, you would have got 10%. Now you have to pay 10%. Okay? So you are going to lose if this happens. This is the risk of leverage. Right? For as long as your borrowing cost is less than the return, you make very good returns. But the moment the borrowing cost goes up, your return will start dropping, and you make negative returns. You will start making losses. Okay, so that is the risk of leverage. Leverage is always good for as long as the return is more than the cost. But the moment the return drops below the cost, you will lose. Okay. Right. So leverage is used to manage risk as well as, derivatives are used to manage risk as well as speculate. Now, classic examples of managing risk, right? When you buy a vehicle, the first thing you have to do is you have to get it insured. Yeah. Now, getting insurance. Why do you get insurance? In case there is an accident, then you have a fallback option. You can get it repaired. So that is managing your risk, because you need to manage risk. So insurance, in other words, is also a derivative product. Yeah. Which is why I said that derivatives, although you don't realize, you use it almost every day in your life. You will insure for something. Then to speculate. Now, speculation is something like you buy shares. Right? You buy shares with the speculation that the market will go up, which may happen, may not happen. So that's called speculation. Right. So in the case of risk mitigation, fluctuations in all kinds of financial prices, including foreign exchange rate, interest rate, and commodity prices, can affect our earnings, right? Now, take, for example, the external debt of Sri Lanka, external debt. It's about some $60 billion of external debt, or $50 billion. If it's $50 billion of external debt, for every 1 rupee that the rupee weakens or the dollar appreciates, our debt burden will increase by 50 billion rupees. For every 1 rupee, an increase of 50 billion rupees, right? Which is massive. So fluctuations in all kinds of financial prices, like an exchange rate or interest rates and commodity prices, can affect our earnings. So if we have borrowings of, let us say, 1 billion rupees, right? If your company is borrowing $1 billion every day, and if interest rates drop by 1%, if you're a net borrower and your interest rate drops by 1%, that means every year you will end up saving about 10 million rupees. For every 1%, you will save 10 million rupees. Okay, so changes in market factors can have an impact on your P&L, your bottom line, and eventually the balance sheet also. Therefore, certain instruments are needed to mitigate these risks, which can be facilitated through derivatives. Right? So you can use derivatives to manage the risk. Something like using insurance to manage the risk of your vehicle meeting with an accident. How derivatives are used? They are used to hedge risk, to manage risk, then to speculate, to take a view on the future direction of the market, to lock in an arbitrage profit, take a view on the future direction of the market, right? That means to speculate. You can use derivatives to speculate. You can certainly use derivatives to speculate. To lock in an arbitrage profit, which is something like this. Okay. If you all can remember convertible debentures, that is where you have a debenture plus a call option. So if the debenture is going at 100, the price of 100, and the price of the call option is 10, your convertible debenture should technically trade at 110. Right? So you have a debenture which is going at 100 plus the call option, embedded call option going at 10. Your convertible debenture should trade at a price of 110. But by any chance, if you find that the debenture, convertible debenture is trading at a price of 105, not at 110 in the market, it's going at 105. You notice this at once. Then what can you do? How will you make money? Right? It has to be 110, but it's going at 105 in the market. So what you can do is, technically, you can start buying the convertible debentures at 105. At 105 rupees, you start buying convertible debentures, and you can sell your debenture and call option separately in the market. Right? These instruments can be split from each other. You can sell a debenture and call option. You collect 100, you collect another 10, but you have spent only 105. Okay, so your revenue is 110, and out of that you are spending 105, you are left with 5. That's an arbitrage profit. Okay, so that's what you can do. So in this instance, you can go long convertible debenture, and you will have to go short debenture plus call option. So if you do this, you make arbitrage profits. Then to change the nature of a liability, right? To change the nature, to speculate means you can buy a call option expecting the price to go up. We will see how it is done. But you can, without the underlying exposure, you can invest in you can buy a call option expecting the price to go up. Or you can buy a put option expecting the price to go down. Right? Then without an underlying transaction, then to change the nature of a liability. That means if you are paying, for example, if you are now paying a fixed rate of interest, right? Let's assume that last year you took a housing loan at a rate of for a period of 20 years. Let's say a 20 housing loan you obtained last year at a fixed rate. Those days you thought interest rates would go up, so you jumped and fixed your interest rate at a rate of 15%. Last year you fixed your interest rate at 15% for 20 years. But now housing loans have come down to, let's say, 10%. Right? From 15%, interest rates are down to 10%. And you expect interest rates to go down further. So under those circumstances, will you want to pay interest? If you expect rates to go down further, you will want to pay interest at a fixed rate or a floating rate if you expect rates to go down. The answer is, if you expect rates to go down, you need to pay interest on a floating rate basis, right? That is because you keep paying interest now fixed. If you pay interest, if you lock in at a rate of 15% for 15 years, then whatever happens, if interest rates go down, you will have to pay at 15%. But if you go for a PLR based rate, as interest rates go down, your PLR rate will also get repriced at a low rate, and you will end up paying a low return or a low rate of interest. Right? So you need to switch from paying fixed to paying floating. That also can be done using derivatives. Then to change the nature of an investment without incurring the cost of selling one portfolio and buying another. Okay, so change the nature of an investment without incurring the cost of selling one portfolio and buying another. Now, for example, if you are a fund that is mandated to invest only in government bonds, right? You have invested entirely in government bonds. 100% invested in government bonds, but you feel interest rates are going up, right? And you also feel that for some reason the stock market will do well. Okay, so the bond interest rates will start going up, and you feel the stock market will start doing well. Then what happens? You will want to switch from bonds into stock market, but that's not possible. Why? Because you have no mandate to invest in stocks. So what you should do is you should try and switch from earning return on bonds to start earning a return on equity. That can be done using derivatives. Then to change the nature of an investment without incurring the cost of selling one portfolio and buying another. Sorry, that's what I just explained. Switching the nature of this investment from bond returns to equity returns without actually physically selling. Actually, if you physically sell such an instrument, you will have to incur transaction cost. Transaction cost will have to be incurred, right? So without doing that, you can use a derivative to switch the nature of the investment from one to another. Okay. Okay, so derivatives have to be used with care, handled with care. It's like handling dynamite. The wrong hands, you can make huge losses. Right? There's been so many cases, even in Sri Lanka. Classic case was the hedging transaction that happened some time back. So that is where CPC wanted to hedge their exposure to crude oil. They entered into transaction with 5 banks, including a couple of local banks, 3 foreign banks, and they ended up paying, actually bleeding a lot of money, right? Bleeding money, that is because although they hedged, they wanted to hedge, they had also inadvertently entered into a transaction which increased their exposure. So they started losing a lot of money. So there are possibilities of large losses. You can make large losses, right? Now, I have given some examples. AIG, during subprime mortgage crisis, AIG lost a lot of money through credit default swaps, CDS, right? During subprime mortgage crisis, a lot of property loans started defaulting. So there were AIG as an insurance company, the largest insurance company in the world, had entered into credit default swaps. That is where they promised to settle lenders in the case of a default, right? Credit default swap. So it gets activated in case there is a credit default. Unless there is credit default, they keep collecting premiums, but no outflows. But no sooner a default strikes, they have to settle the lender, right? Now, when that happened, the Federal Reserve, during subprime mortgage crisis, AIG had to pay out a lot of credit default swaps, lot in terms of credit default swaps, $18 billion, massive. When that happened, the Federal Reserve had to intervene and pump $85 billion to rescue them. So likewise, there are plenty of examples where hedging transactions had gone wrong, terribly wrong. Derivative transaction, I'm sorry. Now, the other one I can remember is Nick Leeson, right, whom we discussed at the very beginning. So Nick Leeson, if you all could recall, was a trader at Barings Bank. Now, he was supposed to do arbitrage, make risk-free profits. He didn't stick to his mandate. He violated and started making losses, huge losses. Right? The bank incurred so much of losses that they had to wind up. Now, Nick Leeson got into Nikkei futures. He was trading in the futures market in Tokyo. Right? And eventually, he lost a lot of money as a result. That also was because he was engaged in derivatives. He was using derivatives to trade and ended up making lots of losses. So derivatives can also carry a lot of counterparty risk. Counterparty risk. The counterparty risk, meaning the risk of default, can be high when you use derivatives. So remember, it's very important, before you engage in derivatives, you have to do a thorough evaluation of the counterparty, right? Because counterparty risk carries lots of risk. Like in the case of a lending, you remember you're carrying counterparty risk whenever you do derivatives. So it's a must that you do a thorough credit evaluation. Without credit evaluations, don't get into derivatives. It's high risk for small and inexperienced investors. Right? If you are small, your transaction volumes are small, and your capital buffer is very low. If you don't have enough capital or reserves, and you make losses on your derivative transactions, then you will be taking a huge hit, massive hit. So it's high risk if you're small and inexperienced, and if you have not done derivatives before, it's very risky, right? I'm not saying you should not do derivatives, but before you do engage in derivatives, you need to be mindful of the pitfalls of derivatives. It can be massively leveraged debt in an economy. So if a country has a huge budget deficit and it gets into derivatives, you are leveraging further, right? Leveraging further and taking on more and more risk. So it might not suit a country which is heavily in debt. Then the notional value involved is very high. Notional value of derivatives can be very high. So what's the notional value? What does notional value mean? Now, if I may give you an example, like if you have, let's say, invested 100 million at 10%, your annual return is going to be 10 million. Right? So this return is calculated based on this capital amount. Right? So this amount that you calculate your return, or the capital amount, in other words, is the notional amount. If you want to do a hedge, if you want to hedge your interest rate exposure, you have to use this capital amount as the notional. So all your calculations will be based on the capital amount or the notional amount. Right, so in derivatives, notional amounts are massive. Large notional amounts are involved. Right? Because in most cases, there won't be a cash inflow or an outflow. There won't be a cash flow. So you can only trade with notional amounts. You can trade only with notional amounts. Therefore, you have to be very careful with the amount that you use. Right. So there can be various types of derivatives: forwards, futures, options, and swaps, covering many aspects. Right now, you have been given credit derivatives, interest rate derivatives, commodity, equity, and foreign exchange derivatives. But this is not all. There are some more. Right? You can have maybe weather derivatives, weather futures. Anything under the sun can become a derivative. Anything under the sun. Even the weather is a derivative, right? It can become a derivative. Credit derivatives. Credit risk is the risk that promised payments on an obligation will not materialize, so you might lose interest or capital, right, if there is a default. Credit derivatives is a class of financial instruments, and the value of which is derived from the underlying market value driven by the credit risk of private or government entities other than the counterparties to the credit derivative transaction itself. Right, so credit derivative products might be credit default swaps and options or forwards. So you can have forwards, futures, options, and swaps on anything, on credit derivatives. Interest rate derivatives derives their value from some money market instruments or reference interest rates. Types of interest rate derivative products: forwards, futures, options, and swaps, basically. Commodity derivatives, the underlying asset of commodity derivative is a commodity or commodity index. Types of commodity derivatives, again, forwards, futures, options, and swaps. Equity derivatives, you again get forwards, futures, options, and swaps. They derive instruments where the underlying asset is an equity security. Generally, an individually shares or equity index, right? Can be an index or actual shares individually. Likewise, you can have foreign exchange derivatives, forwards, futures, options, and swaps on foreign exchange. These are derivative contracts for which foreign currencies act as the underlying asset. Foreign exchange rate would be the main driver of the value of the derivative. So classification by instrument: 4 main types: forwards, futures, options, and swaps. Okay, so let's start with options. Right, options. Now, options are instruments which give you a right but not an obligation to either buy or sell a predetermined amount of underlying asset against a fixed price until or on a fixed future date. So it gives you the right but not an obligation. That's the most important thing about options. You have a right without an obligation. If you want, you can exercise your right. Otherwise, you can forget about it. Okay, so you have a right without an obligation. Now, when you have a right without an obligation, it gives you certain privileges. So, financial markets, where you have privileges, you need to pay for it. Right? There is no free lunch. You need to pay for privileges. If you want privileges, you need to pay for it. That is why when you buy insurance, like insurance products, vehicle insurance, for example, you have to pay a premium to the insurance company. Now that premium is for the risk that the company is taking. Likewise, when you buy a right without an obligation, the seller of this option product will be taking a risk. You have to compensate. Right? And these are the terms: excise price, expiry date, underlying asset, and the premium. Let's discuss and see what it means. Okay. Right. So I'll explain something like this. Now, forget about options for a minute. Let's completely forget about options. Right. Let's forget about what we have done up to now. In fact, on derivatives. Don't completely forget. Have it in mind. But instead of what I mentioned previously, let's start thinking fresh. Right? What happens is, now let's assume. Right, we'll assume that A. Mr. A. I'll write it down. He wants, let's just say, he wants to buy mangoes. On 31st October 2020. Right? He wants to buy mangoes on 31st October 2020. He doesn't want the mangoes today, he wants it about 1.5 months from today. Today, this is today, which is the 12th of September. He wants mangoes on 31st October. Price of a mango today, let's assume, is 100 rupees. He wants to buy mangoes 1 month from today and he's scared that the price of mango will go up. So he comes to me and he asks me at what price I can sell him mangoes on 31st October. And so I will tell Mr. A that I will sell him mangoes on 31st October at a price of 150. I'm willing to sell mangoes 31st October at 150. Not only that, I will tell him that if he wants, Mr. A can buy mangoes from me 31st October, right? If he buys from me, he'll have to pay a price of 150. But if the price of a mango is low in the market, you don't have to buy from me. You can buy from the market at whatever the price that prevails at the market on 31st October. But if I have given you a choice to buy mangoes from me at 150 on 31st October. Now Mr. A is very happy, right? Because he can buy on 31st October from me at a price of 150. But if the price falls, he can buy it from the market. There is no compulsion for him to buy from me, right? So I am taking a risk because if the price of mangoes go up, I can sell it only at 150. Yeah. So for that, since I am taking a risk, I will charge a premium. I will charge Mr. A. Right? There is no free lunch. I'm not giving him a benefit without a benefit to me. Now I will tell Mr. A that for this benefit that I'm giving you, for giving you a choice of buying mangoes from me or from the market, I will charge you. How much? Price of 10 rupees. Right. For this arrangement, I will charge you the price of 10 rupees. Today itself, I will charge you 10 rupees. So you have to pay 10 rupees to have access to this product, right? Right. Now, on 31st October, right, if Mr. A agrees to this arrangement, and on 31st October, if the price of a mango is 200 rupees, market price is 200 rupees, what will happen? What will Mr. A do? Will he buy mangoes from me or will he buy from the market? Mr. A will obviously buy mangoes from me. Why? Because I'm willing to offer mangoes at a price of 150. Right, so Mr. A will buy mangoes from me on 31st October at a price of 150 if market price is 200. So he will make a profit of 200. Right, market price is 200, but he is buying from me at 150 minus 150. But he has already paid me a price of 10. And that is also not off against the profit. He ends up with a net profit of 40. Now, what happens if the price is let's say 180? Then the profit will be 180 minus 150 minus 10. That is the price, a profit of 20. Now my question is, at what price will Mr. A break even? What is the break-even price of a mango? Will be at 160. When the market is 160, he will make 160. He will still buy mangoes from me. He'll buy at 150, right? He'll make 160 minus 150 minus 10, a profit of 0. He will break even when the price is 60. Then at 155, he will still buy from me. He will buy because I am still offering at 150. He doesn't have to buy from the market at 155, so he'll make a profit of 155 minus 150 minus 10. Negative 5. That is because he has paid me 10 rupees already, which is sunk cost. Whether he uses this contract or not, he will have to pay me the 10. Now, what if the price is 150? Mr. Perra is indifferent. He can either buy from me or from the market. Right? So either way, there is no difference. He will end up losing 10 bucks. And if the price is 140, market price is 140, will Mr. Perra Mr. A come to me and buy mangoes from me? If he is buying mangoes from me, he has to pay a price of 150, but he can buy from market at 140. And so this contract is not going to be used. He will forget about it, but he has already paid me 10 rupees. So he will lose 10. Then if the market price is 100, he has paid me 10 rupees. He is not going to use the contract because he can buy from the market at 100. So he will end up losing 10. Then if the price of a mango is 0, he doesn't have to buy from me at 150. He can buy from the market paying nothing. But he has already paid me 10 rupee price. Right? So if you look at these results, anything below 150, anything below 150 will result in a profit of a loss of 10 rupees. So if you draw this in a diagram, and you plot the profit against the market price, right, until a price of 150, the market remains negative at 10 rupees. Break even at 160. And can go up. Right. His break-even price will come at 160. Okay. Now the lowest price that a mango can fall is 0. Beyond this, nothing happens, right? But the highest possible price that it can go up to is unlimited, meaning he can make unlimited profits. Now, in this instance, Mr. A has bought this product from me and I have sold it to him. So whenever he makes a profit, I will lose. No? Because somebody has to pay the profit that Mr. A pays. If somebody has to pay, I'm the one who pays. Now, how much of profit will I make? I'll be buying mangoes at 200, selling to him at 150, but I will buying mangoes at 200, selling to him at 150, I will make a 50 rupee loss. But I have earned 10 bucks, so I end up losing 40. So I will lose 40, he will gain 40. To add up the two, comes to 0. This is called a zero sum game, right? Meaning Mr. A's profit will be my loss. Here I will lose, like, I will lose 0. And what happens here? When Mr. A loses 5, I will receive the 5. I get 5. Here I get 10. So I get 10 again, 10 and 10. Now this is how it looks. What Mr. A is going to lose, I will gain. And what he will gain, I will lose. Right? And if you add the two numbers, it will always come to 0. Zero. Always 0. Yeah. Right. So if you plot it in this diagram, when Mr. A makes a 10p loss, I will make 10p profit. Yeah. And his profit is my loss, my profit is his loss. So it will be a mirror image. Right. Mirror image. Now Mr. A has bought this contract from me, so he has bought. If you buy, it's called long. Whereas I have sold this product to him, so I am short or sold. It's also called written. Yeah. Now, what is the highest possible profit that A will make? Highest possible profit? So if you're long, A is long, highest profit. It's technically infinite. You can make infinite amounts of profits. The highest loss will be the 10, right? Now, something I could mention is the price of a mango today is called the spot price. This is the spot. Right? And the price that I'm willing to pay on 31st October is called strike price. 31st October is the expiry date. And the price that he pays me to purchase this product is called premium. Premium. Now, so these are the technical terms which you all need to remember. There isn't much, very easy concept. Premium is the price of this product. Expiry is when it matures. Strike price is the price at which the settlement happens. Now this product gives A the right to buy mangoes from me, isn't it? But he has no obligation to buy. He has a right to buy. Okay, so this entire thing is based on the price of mangoes. So mango is called the underlying. Based on the price of mango, it's called the underlying. And it gives him the right. Very important word, the right to buy but no obligation. Product which gives you the right to buy is called a call option. Okay. So this diagram is called the payoff diagram. Of a call option. This is the payoff diagram of a call option. And again, if you are long, the highest profit is infinite. The highest loss you will make is the premium. Right. And if you are short, highest profit is 10 rupees, which is the premium. And the highest loss is infinite. Excuse me. Then the profit, if you are long, will be the market price minus the strike price minus premium. Market price minus strike price minus the premium. Now market price minus strike price is called the intrinsic value. Minus premium. Right, intrinsic value minus premium. Remember, intrinsic value will always be positive and a positive number. It will always be a positive number. It can never be a negative number. Right. Then if you go back to the payoff diagram, anything less than the strike price, right? Less than the strike price, the call option will not be used. So that in that region, if the price is less than strike price, nothing will happen. So it's called out of the money. When market is equal to strike price, it is called at the money. Or when the market is more than the strike, it's called in the money. So there are three regions: out, at, and in the money. Okay, so that's a call option. Very simple. Simple theory. Call options. Yeah. Right. So I hope it is clear. Second scenario. Let's say Mr. B Mr. B wants to sell mangoes on 31st October. Let's say Mr. B has a mango plantation. Right? B has a mango plantation and he wants to sell mangoes on 31st October. Right. So he doesn't want to sell mangoes today, he wants to sell 31st October. Today, the spot price of a mango is 100. Now, he comes to me and asks me at what price I can buy mangoes on 31st October. Right? What price I can buy mangoes on 31st October. So I will tell him that I am willing to buy mangoes on 31st October at a price of 80 rupees. Right, at a price of 80 rupees. But I tell him he has a right to sell, but no obligation. On 31st October, he has right to sell mangoes to me at 80, but he has no obligation. Yeah. Now, previously I gave him the right to buy mangoes. Now I am giving him the right to sell, right, at a price of 80. And again, it's based on the price of mango. So mango again is the underlying. And the right to sell is called, the product will be called a put option. A product which gives you the right without an obligation to sell is called put option. This will be the strike transaction, if it happens, will happen at 80. Right. And I tell him, for this arrangement, now he's benefiting. He has a right to sell, but no obligation. So I have relieved him of any obligations. So I will tell B that for this arrangement, he has to pay me a price of 15, right? And the price that he pays is technically called a premium. 15. So B has to pay me a premium of 15 if he is agreeable to this option, to this product, right? Okay, now on 31st October, if the price of a mango is 150 rupees, what will B do? Will he sell it to me? If so, he will have to sell it at 80, or will he sell it in the market? Answer is he will obviously sell it in the market because he can get a higher price and he has no obligation to sell to me, right? Now compare this against a forward. If it was a forward, the difference is this part is not there, right? He has to sell. It's a must. He has not. It's not a right. It is a must that he sells. He has an obligation in that case. But here there is no obligation, only a right to sell. Right. So if the price of mango is 150 on 31st October, he sells in the market at 150, and he makes a profit of 70. But he has paid me a premium of 15. So he will end up with a net profit of 55. Right. Then if the price is 100, he will sell it still in the market at 100. He will make 20 bucks on the transaction minus 15, so he ends up with a profit of 5. What is the break-even price? If the market price of the mango is 95, he sells to me at 80, he will break even at 95. Now what happens if the price is 80? Market price is 80. He makes nothing on the transaction, but he has paid me 15, which he will lose. Then if the price is 50, right? If the price is 50, sorry, one moment, I made a mistake. This is where he has to sell, so he is not going to use these transactions in this case, right? It is my mistake, my apologies. If the price is 150, market price is 150, he is not going to use the transaction, but he has paid me 15 bucks. So he will lose 15. Right? And if the price is 100, he is not going to use the contract, but he has paid me 15. So he will lose 15. Then at 95, because he's selling mangoes to me. Yeah? At 95, he's selling in the market. He's not going to use the contract, but he has paid me 15. I'm losing 15. Now, if the price is 80, he can either use the contract or not, but he ends up paying me a net of 15. Right? Now, this 15 is the premium. Right? So, what if the price is 70? Market price of mango is 70. Then, will he sell it in the market or will he sell it to me? He will sell it to me. Why? I will buy mangoes at 80. So he will sell mangoes to me at 80, market is 70, but he has paid me 15. So on the transaction he makes 10, but he has paid me 15. So overall he ends up with negative 5. Then if the price is 65, at what price does Mr. B break even? If the price is 65. Why? At 65 he sells to me at 80, market price 65. paid me 15, we will break even. If the price is 50, 80 minus 50 minus 15, 15 bucks. And if mangoes become worthless, he will sell it to me at 80. But he has paid me 15. So that is 65. Now if I plot this result on a diagram, if the price is 80 or above, Mr. B will lose 15. Right? And he breaks even at 65. And if mangoes are worthless, he makes 65. Okay, so if we do a similar analysis, right? Once again in this arrangement, B has bought this product from me, right? I have sold. So B is called long, is long put. I have sold put option to B, right? This short put. Minus 65. So if you are long, maximum profit. If you are long, your maximum profit is, in this case, 65, right? Which is strike minus premium. Maximum loss is 15, the premium. Premium is 15. Then if you are short, maximum profit, again a zero sum game. So the maximum profit is maximum loss of the long premium, and maximum loss, maximum profit of the long strike minus premium. Then if you are long, profit would be it was market minus strike earlier, now it becomes strike minus market minus the premium. Strike minus market is called intrinsic value. Minus premium. And the same condition applies. Intrinsic value is always a positive number. It can never be a negative number. Right. So the regions, now anything beyond above the strike price, the option will not be used. It is called out of the money When market is equal to strike, it is called at the money. And when market is less than strike, it is called in the money. So these are the different regions. And that's all there is to it. This is the entire theory on options. Everything is here. If you know this, options will be very easy, very simple. It's not complicated at all. Right. So I hope all this is clear. Right. So option premium. Remember, it's always the option buyer who pays the premium to the option seller. Right. So it's always the long pays the short. The opposite does never happens. The short will not pay the premium to the long. An option premium represents the price paid by the buyer to the seller to assume the price risk of the underlying. Right. So the seller assumes price risk, and to compensate for that, the buyer of the option has to pay the seller of the option. American and European options. Now, this option that we did earlier for A and B, and this option that we did for A and B. Now, A was given an option which expires on 31st October. And so he can use this option on 31st October. Now, there is another kind of option which is a little more flexible. He can use it any time between 12th September to 31st October. So any time the price of mango goes up, he can use it. Right? That is more flexible. It's called an American option. Can be used any time before expiry. Or options can also be European, which is rigid. You cannot use it before it expires. You can only use on the expiry date. Can only be used on expiry. Can only be used only on expiry. Now, American options are more flexible than European options. Right? So they are more flexible, meaning they give the purchaser of the option more privileges. Right? So to buy more privileges, he has to pay a higher price. That means the premium of an American option is always more than the premium of an identical European option. Right? So American option, premium of American option is always more than the premium of an identical European option. Right. So remember, a call option gives you the right without an obligation to buy the underlying, and a put option gives you the right without an obligation to sell the underlying. Okay, so call options. A call option is a contract which gives the holder the right but no obligation, not an obligation, to purchase a certain agreed asset for agreed price known as exercise price, and an agreed date in the future known as the exercise or expiry date or the maturity date. Put option is a contract which gives its holder the right but not an obligation to sell a certain asset for an agreed price known as exercise price at an agreed date in the future known as the expiry date or maturity date. Right? What we covered earlier. Then the value of an option. In the money option, for call option is where the market is more than the strike price. Right? Out of the money, if the market is less than strike price. At the money, market equals the price. Put option, if the market is less than the strike, it is in the money. Out of the money is market more than strike. At the money, if the market is equal to strike. Right. So inputs for pricing options. You need exercise price, interest rates, time, and volatility. Right. The price of an option depends on these factors: exercise price, interest rates, time, and volatility. So let me erase everything. I hope this was clear. Price of an option depends on price of an option depends on the spot price, the exercise price, the time period, the volatility, and interest rates. On these factors. So options are priced based on a model called Black-Scholes model, the Black-Scholes model. And these are the inputs: the spot price, exercise price, time, volatility, and interest rates. Now, how do option prices changes with spot rate? For call options and put options. Now, to give you an analogy, it's like this. I mentioned initially that insurance is like an option. You buy insurance to safeguard yourself, right? So when you purchase insurance, the insurance premium will be high. The cost of insurance is called the premium, like the cost of the price of an option. So the insurance premium will be high when the value of the vehicle is high or low when the value of the vehicle is high, right? So higher the price of the vehicle, higher the insurance cost. So likewise, higher the price of the underlying, higher the cost of what? Call option or a put option. Higher the cost of a put option. This has a positive relationship. Why? Because when you sell, put option gives you the right to sell. When you sell, you will want to sell at highest possible price. Right? So selling at higher price is a privilege. And for the privilege, under privilege, you have to pay more. Right? So higher the price of the underlying, higher the premium of a put option. But for call options, when you want to buy, you will want to buy at the lowest possible price So if the price of the underlying is high, it is not a privilege. You will not be privileged, and to compensate for that, you will pay less. Okay, so higher the spot price of the underlying, lower the premium of a call option. This is going to have a negative relationship. This will have a negative relationship. Put options will have positive relationship. Then when it comes to exercise price, the similar relationship applies, right? Because exercise price is high. When you want to sell, again, you will want to sell at the highest possible price. Selling at a higher price is a privilege. For that, you have to pay more. Therefore, put options will cost you more if the strike price is high. Right? This will have a positive relationship. Whereas if you want to buy and the price is high, you are not privileged. Therefore, your premium will be lower. Right? So higher strike call options will have lower premiums compared to lower strike call options. This will be a negative relationship. Right? Okay. Time. That means now again going back to insurance. If you want to insure your vehicle for 1 year, and there is let's assume there is another option to insure your vehicle for 1 month, right? If there are 1 month insurance products, the 1 month insurance product will cost you less than the 1 year insurance product, right? Because the time period is less means the insurance company is taking a lower risk, right? So longer the time period, higher the uncertainty, therefore higher the premium, right? So this will have a positive relationship, whether it is call or put. Volatility. Now, if you drive vehicles and you meet with accidents every day, your risk is high now. So risk, remember, is measured by volatility. And so if your risk is high, what happens to your premium? Your insurance premium will also be high. Right? So higher the volatility or higher the risk, higher the premium. Whether it's call or put, it doesn't matter. It's always a positive relationship. And interest rates, right? When inflation is high, insurance premium will be high. Right? So again, interest rates will also have a positive relationship. So this is how each factor will have either positive or a negative relationship to how the premium will change as each of these inputs change. Right? The relationship of the premium to each of the factors, input factors. Option settlement. Option settlement. Settlement of options will be based on the expiry date, settlement date. Then, now for example, right, the first example that we did, A wants to buy mangoes from me on 31st October, right? So 31st October, let's say in the morning, the strike price in that case was 150. In the morning, let's say the price of a mango is 200 rupees. So A will obviously want to exercise his option, but what if at 3 o'clock in the afternoon, price of a mango is 100 rupees? Then he will not want to buy from me, he will want to buy from the market, right? So during the course of the day, the price keeps fluctuating. Now, how do you pick when it's going to be settled? When you strike option contracts, it will always be mentioned that the option will be settled on 31st October at a given time, right? Might be 10 o'clock Sri Lanka time. And so whatever the price that prevails at 10 o'clock in Sri Lanka time, and you have to specify which market you're using, right? Whether it's the Gaul market, the Hambantota market, the Anuradhapura market, Dambulla market, different prices, right? Maybe Colombo market. Right? So you might say the price that prevails at Dambulla at 10 o'clock on 31st October is the price that is used for settlement. So everything has to be defined, very clearly defined. Then you can have physical delivery versus cash settlement. Okay, so what might happen is now on 31st October, where A wants to buy mangoes from me, if the price of a mango is 200 rupees, he will want to exercise the option, so he will buy mangoes from me. Now I have two options, right? I can either give him a mango, a physical mango. I go and find A and give him a physical mango. So what A can do is he can take the mango, he can sell it for 200 bucks in the market. He can buy the mango from me at 150. Right? Remember he's buying mangoes from me at 150. He goes to the market, sells it, he gets 200 bucks. Straight away he gets the 50 rupee profit minus the original 10 rupee premium that he paid to me. He'll end up with 40 rupees. That is also possible. That's called physical delivery. I physically delivered a mango to him. He can also do this. The other settlement way is cash settlement. Right? Cash settlement is, instead of all of that, if I still give 40 bucks to A, it comes to the same thing, right? Because I have to buy mangoes from the market at 200 rupees and I'm selling it for 150, right? So I will make a 50 rupee profit. Sorry, a 50 rupee loss. But A has settled 10 rupees to me at the very beginning. Now, net of that, I have to pay him 40 rupees. So what if I give him 40 rupees straight away? Then still it comes to the same. So settlement of an option can either be physical delivery or cash settled. Risk and rewards we covered. Now, the maximum loss of an option will be when you sell an option. You will incur the maximum loss if you sell an option. Remember, maximum loss of a call option is unlimited. Maximum loss of the put option is the strike minus market. Right? Strike minus market. Now, maximum loss on a put option will be, in fact, the strike price, right? Because the lowest price the market can come to is 0. No? So strike minus 0 is the strike price. Now, if you all notice, the maximum price of a call option is unlimited, maximum price of put option is strike. Now, out of those two, the riskiest is the unlimited loss. You're exposed to unlimited loss if you sell call options, right? That is the riskiest thing you could ever do. So if you want to commit suicide, that's the best way of doing it. Sell call options. Very, very risky. Maximum profits, break-even prices, all that we covered. But what you need to remember is the maximum loss you make from an option is through selling call options, right? Your losses can never be higher than selling call options. Right. By the way, the diagrams that we use, the payoff diagrams that we use for options, right? Whether it's long call, short call, long put or short put are standard documents. So no sooner you see in a question, if you see long call, you should be able to draw the payoff diagram straight away, right? Later on, you can mark the values, but you should be able to draw the diagram. Okay, and if it's a short put, again, you should be able to draw the diagram before you put any values. You can put the values straight away later on, but straight away you should be able to draw the diagram. That's 50% of the battle won. Right? If you draw the diagram, remember always you need to draw a diagram. When it comes to option questions, you need to always draw a diagram. Right, so let's try these questions. Question number 1, you asked to calculate the value of the following put options and draw the payoff diagrams, right? So you have to calculate the value of the following put options and draw payoff diagrams. Put options, these are put options. First one is your long. You're long, strike price 100, premium 4, stock price is 90. Second question, you're short, strike price 100, premium 4, stock price is 110. So let us draw these. Step 1 is to draw the payoff diagram. Right. So if you're long put, right, these are put options, you're long, you need to draw the long put. This is the profit against the market. Strike price is 100. Strike is 100. Premium of 4. Stock price is 90. Break-even price, if you all could remember, will be 96. Stock price is 90. And when the market is 0, you will make a $96 profit, right? Okay. Now you asked to calculate the profit. Profit for the long put will be the strike minus market minus premium. Strike price 100. Market is 90. Right. So intrinsic value in this case is 10. Now the strike is higher than the market, so it is in the money. Intrinsic value is 10 minus the premium of 4. Right. So you will end up with 10 minus 4, which is a $6 profit. You make a $6 profit. Question number 2. You're short. Strike price 100. Premium 4. Stock price 110. So you're short. Short a put option, right? Put option, you're short. So let's draw the payoff diagram. I'm not drawing to scale. This is not drawn to scale, so nevertheless, let's mark the values. You receive 4, premium is 4. It's a mirror image of the previous one. So the profit. Your profit will be, if the stock price is 110, right? It's at 110. Now at 110, this 110 is out of the money. Yeah, 90 is in the money because the price is less than strike, so it's in the money. Whereas 110, it's above the strike. Right? The price is above the strike, so it is out of the money. So you're short, and if the option is out of the money, you make a $4 profit. Profit will be $4. Right? Because you are short and the option is out of the money, you make the $4 profit. Yeah. So that's how it goes. Now remember, you all have to be able to draw a payoff diagram. You should be familiar with the payoff diagram. No sooner you see the question, you should be able to close your eyes and draw a payoff diagram. You should be so confident. Right? The moment you get the payoff diagram right, you won 50% of the battle. Okay. Right. So what we'll do is we will Now, yeah, next one is on call options. So this is how we draw it. Remember, the first step is to draw the payoff diagram, mark the regions or the levels. You can draw the strike price, break even, and the premiums, right? And then mark where the current price is, the market price is. Based on that, you can calculate profit. So if you are long, this is the calculation you use. And if you're short, depending on where you are, where the market is, you can do a profit calculation also. Right, so time is up for today. We will continue next week through a live session. Have a safe week. Thank you and all the best.